China possesses $3.2 trillion in United States assets. This includes Treasury bonds, agency debt, corporate equities, and massive cash reserves. It is the largest stockpile of dollar exposure held by any single nation on the planet. It is more than Japan, more than the United Kingdom, and more than the entire European Union combined. For the last 20 years, financial analysts and politicians have whispered about this number with fear. They describe it as a weapon. They warn that if relations between Washington and Beijing ever collapse, China could simply push a button, sell everything, and destroy the American economy overnight. They call it the financial nuclear option. The theory is that by flooding the market with sell orders, China could spike United States interest rates, crash the dollar, and bankrupt the American government. However, there is a critical secret that very few people understand. China cannot use this weapon. In fact, it is not a weapon at all. It is a hostage vest, and China is the one wearing it. The moment Beijing attempts to pull the trigger and dump these assets, they do not just damage the United States, they completely annihilate their own economy. The $3.2 trillion is not leverage, it is a trap. Both the United States and China are now locked into a financial suicide pact that neither side knows how to escape. This situation is the most complex financial deadlock in human history. You have two superpowers, each pointing a loaded gun at the other, but they are chained together by the same currency system. What makes this situation truly terrifying is not the hypothetical threat of a future crash. It is the fact that the unraveling has already begun. China knows they are trapped. They have spent the last 15 years frantically buying gold, building alternative payment rails, and trying to internationalize the yuan to find a way out. But the trap is too deep. The exposure is too massive. The escape route is too narrow. The question is not whether China wants to destroy the dollar system. The question is whether they can survive the exit. Let me explain exactly how the United States locked down $3 trillion of China's wealth, why the trap is mathematically inescapable, and what happens next as the world's second-largest economy realizes it has nowhere to go. We must begin by looking at the scale of the trap. When the news media discusses China's debt holdings, they usually cite the official Treasury Department figure, which is roughly $731 billion as of late 2025. This figure is misleading. It suggests that China's influence is shrinking, as this is the lowest level of direct Treasury ownership since 2009, but looking only at official Treasury data is like looking at the tip of an iceberg and ignoring the mountain of ice beneath the water. The $700 billion is just the direct debt. China also holds hundreds of billions in United States agency debt bonds issued by entities like Fannie Mae and Freddie Mac. They hold massive stakes in United States equities through sovereign wealth funds. They hold hundreds of billions in corporate bonds from American companies. And they hold a mountain of cash deposits in dollar-denominated accounts to facilitate trade. When you aggregate the treasuries, the agency debt, the corporate bonds, then the equity positions, the real number is somewhere between $3 trillion and $3.5 trillion. This is not pocket change. This represents the accumulated savings of the Chinese people over 40 years of industrial labor. It is crucial to understand how they acquired this money because the origin of the money is the reason for the trap. China did not buy these dollars because they loved the United States government. They bought them because they had no choice. From the 1980s until today, China ran an economic model based on export-led growth. They became the factory of the world. They shipped electronics, textiles, steel, and machinery to the United States and Europe. In exchange, the world sent them dollars. When a Chinese manufacturer sells a shipping container of widgets to Walmart, Walmart pays in US dollars. The Chinese manufacturer cannot pay their workers in dollars. They need yuan. So, they take the dollars to a Chinese bank and exchange them. The commercial bank then passes those dollars up to the People's Bank of China, the central bank. This created a massive problem for the central bank. Billions of dollars were flooding into China every single month. If the central bank simply exchanged all those dollars for yuan and released them into the economy, two things would happen. First, domestic inflation would explode. Second, and more importantly, the value of the yuan would rise. A strong yuan is terrible for an export economy. If the yuan becomes more expensive against the dollar, Chinese goods become more expensive for American consumers. If Chinese goods become expensive, Americans stop buying them, and the factories in Shenzhen shut down. To prevent this, Beijing had to artificially suppress the value of their currency. They did this by taking those incoming dollars and recycling them, instead of selling the dollars on the open market, which would lower the dollar's value. They kept the dollars and used them to buy United States assets. Specifically, they bought Treasury bonds. By buying treasuries, China created artificial demand for the dollar, keeping the dollar strong and the yuan weak. This ensured that Chinese exports remained cheap and the factories kept humming. This cycle continued for 40 years. China shipped goods. America shipped IOUs. China got jobs and factories. America got cheap televisions and low inflation. It seemed like a perfect symbiotic relationship. But in the process, China accumulated a $3 trillion pile of IOUs that they can never actually cash in. This brings us to the nuclear option. You often hear politicians ask, what if China gets angry and sells it all? Let us play out that scenario step by step to show you why it is a suicide mission. Imagine it is Monday morning. The order comes down from Beijing to the state banks. Sell everything. Dump the treasuries. Dump the agency debt. Liquidate the stocks. The first thing that happens is a liquidity crisis in the United States Treasury market. The market is deep, but it cannot absorb $700 billion of selling pressure all at once. The price of U.S. bonds would crash. Because bond yields move inversely to prices, interest rates in the United States would spike violently. The 10-year Treasury yield could jump from 4% to 8% or 10% in a matter of days. This would devastate the United States economy. Mortgage rates would hit double digits, freezing the housing market. Corporate borrowing costs would explode, causing a wave of bankruptcies. The United States government would face a funding crisis as the cost of servicing its own debt doubled. It sounds like a victory for China, does it not? They have successfully crippled their rival. But now, we must look at the blowback. The effects on China would be immediate and far more lethal. First, consider the value of their remaining assets. If China starts dumping bonds, the value of those bonds crashes. That means the remaining $2 trillion of assets they are still holding are losing value by the second. By engaging in a fire sale, they are destroying the value of their own savings. They would be selling assets for 50 cents on the dollar, effectively burning hundreds of billions of dollars of their own national wealth. Second, and more catastrophically, is the currency impact. If China sells dollar assets, they are selling dollars and buying yuan. This floods the market with dollars and sucks up yuan. The result is that the value of the dollar collapses and the value of the yuan skyrockets. This is the exact nightmare scenario Beijing spent 40 years trying to avoid. If the yuan appreciates by 30 or 40% overnight, the Chinese export machine dies instantly. Suddenly, a toaster made in China costs 40% more at Target. A Huawei phone costs 40% more in Europe. Global consumers would immediately stop buying Chinese goods. They would switch to products from Vietnam, India, or Mexico. China's entire economy is still structured around manufacturing and exports. Millions of Chinese factory workers would lose their jobs within weeks. Factories would close. Social unrest would spread across the industrial provinces. The Chinese Communist Party values stability above all else, and an export collapse is the ultimate threat to that stability. Third, there is the issue of domestic banking. The Chinese banking system is heavily leveraged. Many Chinese companies have borrowed money in dollars because interest rates were low. If the global financial system seizes up, these companies cannot roll over their debt. Furthermore, the assets sitting on the balance sheets of Chinese banks would lose value. A financial crisis in the US would trigger a mirror crisis in Shanghai, but China has fewer safety nets to handle it. Finally, you must look at what China buys. China is the world's largest importer of energy and food. Oil, soybeans, and natural gas are priced in dollars globally. If China destroys the dollar system, global trade grinds to a halt. Supply chains shatter. China might have trillions in paper wealth, but they cannot eat paper, and they cannot put paper in a gas tank. If global trade freezes, China starves and freezes. So, the nuclear option is not a gun pointed at America. It is a suicide vest. If they trigger it, they might take the US down with them, but they will definitely destroy themselves in the process. This is mutually assured destruction. Because this frontal assault is impossible, China has been attempting a different strategy. They are trying to pick the lock of the trap rather than blowing up the door. This strategy involves 3 slow, methodical steps: accumulating gold, building alternative payment systems, and internalizing their economy. Let us look at the gold strategy. For the last decade, the People's Bank of China has been a relentless buyer of gold. Officially, they report holding over 2,000 tons. However, many analysts believe the real number is much higher, perhaps double or triple that amount, hidden in off-balance sheet vehicles and state agencies. By buying gold, they are trying to swap a paper asset that the US controls for a hard asset that no one controls. If the dollar system collapses, gold will skyrocket, potentially offsetting their losses on treasuries. It is a hedge. But even 5,000 tons of gold is worth roughly $400 billion. That is a lot of money, but it is only about 10% of their total foreign exposure. It is not enough to replace the dollar. It is an insurance policy, not an exit strategy. The second step is the creation of CIPS, the Cross-Border Interbank Payment System. This is China's answer to SWIFT. It allows banks to settle transactions directly in yuan, bypassing the US dollar system entirely. If China can convince Saudi Arabia to sell oil in yuan, and convince Brazil to sell soybeans in yuan, then they do not need to stockpile dollars. This strategy is working, but it is moving at a glacial pace. In 2015, the yuan accounted for less than 2% of global trade settlements. Today, it is around 7%. That is a significant increase, but it still leaves 93% of the world trading in dollars, euros, or other currencies. The problem is trust. To replace the dollar, the world has to trust the issuer of the currency. The United States has deep, liquid markets and the rule of law. China has capital controls and a government that can freeze assets at will. International investors are hesitant to hold billions in yuan because they do not know if they will be allowed to take the money out of China when they need it. The third step is the dual circulation strategy. This is Beijing's plan to shift their economy from being export-dependent to being consumption-dependent. They want the Chinese people to buy Chinese goods, reducing the reliance on American consumers. If this works, China stops accumulating dollars because they stop running such a massive trade surplus. But this transition is incredibly difficult. Chinese wages are rising, but not fast enough to consume all the excess production. And as wages rise, manufacturing becomes less competitive, pushing factories to move to cheaper countries. So, we are left with the reality of the timeline. China is diversifying, but the math suggests it will take them another 20 years to reduce their dollar exposure to a safe level. They need to get that $3 trillion number down to something manageable, perhaps under $1 trillion. But does the system have 20 years left? This is where the United States enters the picture as the other prisoner in this trap. Washington knows China is stuck. This knowledge gives the United States tremendous geopolitical leverage. It allows the U.S. to impose sanctions, restrict technology exports, and conduct naval exercises in the South China Sea, knowing that Beijing's financial retaliation options are limited. However, the United States is also trapped. The U.S. government is currently adding $2 trillion to the national debt every single year. The total debt is approaching $38 trillion. Interest payments on that debt are now one of the largest items in the federal budget, exceeding the defense budget. The United States needs the world to keep buying its debt. If China, the second largest holder, slowly stops buying, and then eventually starts slowly selling, who picks up the slack? Currently, the Federal Reserve and domestic investors are absorbing the debt, but this cannot last forever. If demand for U.S. Treasuries dries up, the U.S. government has to print money to buy its own debt. That leads to persistent inflation and the devaluation of the dollar. If the dollar collapses under the weight of U.S. debt before China can diversify, China still loses. Remember, they are holding $3 trillion of this paper. The U.S. debases the currency to save itself. They are effectively stealing the purchasing power from China. It is a race against time. China is trying to exit the building before it catches fire. The United States is trying to keep the building standing while adding more fuel to the basement. There are three ways this story ends. Scenario 1 is the soft landing. This is the optimistic view. China successfully transitions to a consumer economy. The U.S. manages its deficits. The world slowly shifts to a multipolar currency system where the dollar, the yuan, and the euro share status. This takes decades and requires cooperation. Given the current geopolitical climate, the probability of this is low. Scenario 2 is the crisis trigger. A geopolitical event, perhaps over Taiwan, forces a rupture. The U.S. freezes Chinese assets, just as they did to Russia in 2022. China responds by seizing U.S. assets within its borders and dumping whatever liquid bonds they can access. The global financial system fragments instantly. Trade stops. A depression ensues. This is the hard decoupling. It is fast, violent, and destructive for everyone. Scenario 3 is the slow burn. This is what we are seeing right now. China continues to trim its treasury holdings month by month, replacing them with gold and strategic resources. The U.S. continues to use inflation to erode the real value of the debt it owes to China. It is a silent war of attrition. In this scenario, the value of your money, whether you are American, Chinese, or Europeans, the collateral damage. As these two giants wrestle, they are both incentivized to manipulate their currencies and secure hard resources. So, what does this mean for you? It means that the financial architecture of the last 40 years is structurally unsound. The era of cheap Chinese goods and stable U.S. interest rates is ending. We are moving into an era of higher inflation, supply chain volatility, and a battle for hard assets. The $3 trillion that China holds is not a pile of wealth. It is a pile of liability. It represents a promise that the United States may not be able to keep in real terms. The smart money understands this. That is why central banks around the world, not just China, are buying gold at record rates. They are preparing for a future where sovereign debt is no longer the risk-free asset it used to be. The standoff over this $3 trillion is the invisible war that defines our time. China cannot dump it. The U.S. cannot pay it back. And until something breaks, both sides are simply staring at each other, waiting for the other to blink. If you found this analysis valuable, make sure you subscribe. We are tracking the flow of global capital to show you where the cracks in the system are forming. In our next video, we are going to investigate the specific shadow reserves China is using to hide billions of dollars from the official books, and why some economists think their gold hoard is actually 3 times larger than reported. You do not want to miss that.